So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately. We're going to go through a handful of these to see if we can shed some light on the things you want to know the most. Starting with this question here from Mark, who asks, if you could start all over, would you just go with SCHD and not all those individual companies, or would you do things the same way? Now, this is a really great question, and just for some context, guys, when I first got serious about dividend investing, which was probably about a year or so after I started investing in general, and it was probably a few months after I started posting videos here on YouTube, I loaded up my portfolio with about 15 different individual stocks. This is what my portfolio looked like right after making the decision to adopt a dividend investing strategy. And a lot of the companies we see here are going to be recognizable names, some of which I still own today. But if I could start all over, knowing what I know now, I would definitely take a different approach. I wouldn't have so many individual companies right off the bat. I just think that was way too many, and I ended up not sticking with a lot of the companies that I initially started with. And believe it or not, starting from scratch, I also wouldn't go all in on SCHD, which I do love, but I wouldn't go all in on SCHD or ETFs in general. And the reason for this is because investing in individual stocks has taught me about a wide variety of subjects like accounting, economics, and psychology, which are things I might not have learned if I had just stuck with ETFs. And I get that a lot of people find investing in individual companies to be a lot of work, and they don't really understand why someone would do it when they can just invest in ETFs. But I personally really enjoy the process of doing so, and I get a lot out of it. So with that said, if I had to start investing from scratch, I would still invest in some individual companies, but I definitely wouldn't need 15 different ones. As a beginner, I think the ideal portfolio setup for me would have been a mix of SCHD and VU as the foundation, which is pretty much what I have now in my Roth IRA, and then maybe about 3 individual stocks on top of that, no more than 3. Overall, I think this sort of approach would have been much better than what I actually did, and it would have given me the best of both worlds in a more streamlined way. The ETFs would have provided the diversification I was trying to achieve, having those 15 different stocks, while the few individual stocks would have been a great starting point in developing my stock research skills. I actually think this would be a great setup for anyone who's new to investing and feels like they need to own some individual companies. It kind of scratches that itch for you while at the same time still offering some sort of safety net, which is probably necessary for all new investors. But anyway, before we move on, I want to put it back on you guys real quick. If you had to start investing from scratch, knowing what you know now, how would you set up your portfolio? Let me know in the comments below. But anyway, moving on to this second question here from Tidal Wave 1. Tidal Wave wants to know, does stock price, whether ETF or individual stock, matter when choosing what to invest in? Is it better to buy more shares with a lower share price, say below $50 per share, versus a stock that is $200 per share? Now, I actually get this question quite a bit, and truth be told, the stock share price really doesn't matter, and it doesn't tell you anything about the quality of the investment. In other words, a $200 stock isn't necessarily a higher quality investment than a $50 stock, and vice versa. A $50 stock isn't necessarily a lower quality investment than a stock that's $200. And at the end of the day, the share price alone isn't a useful metric for comparing two different companies. It really only affects the number of shares that you can buy. And as an example, if you have $1,000 to invest, you could purchase 20 shares of a $50 stock or 5 shares of a $200 stock. However, the fact that you can buy more shares of the $50 stock doesn't make it the better investment. Let's compare Visa, which has a current share price of about $266.50, and Walgreens Boots Alliance, which is currently priced at $10.85. With $1,000 to invest, you could buy 3.75 shares of Visa, or with that same amount of money, you could buy just over 92 shares of Walgreens. Now, owning more shares of Walgreens might feel more impressive, and you might even be tempted to go with Walgreens just so you could have the higher number of shares. But remember, at the end of the day, it's still the same amount of money invested either way, and you'd much rather be invested in whichever business between these two is going to be the higher quality one. And it's undeniably Visa in this case, at least in my opinion. But anyway, now moving on to question number 3. This one comes from Valiant Valrin, who says, first-time investor, do you have a checklist on what to look for in dividend stocks? And I do. I actually have a fully comprehensive process that I follow using my Investor's Almanac tool, which is coming soon, guys. I'm hoping to have this out sometime in the next month or the next 2 months. And I know I've said that before, but it is coming, I promise. But this Investor's Almanac tool and the research process that comes with it spans everything from a company's background, its financials, management team, valuation, and more. And if you want to get your hands on this tool and stay updated on its release, you can do so by signing up to the waitlist. I'll include the link to it in the pinned comment. And probably sometime in the next couple of weeks, I'll be sending out some more details on the Investor's Almanac, so definitely stay tuned. And with that said, guys, if you are a brand new investor, then you might be looking for something less intense. You might not need the Investor's Almanac quite yet, in which case there are 3 things that are very easy to look at that I think every brand new investor can and should look at when analyzing dividend stocks. The first and most crucial thing is to determine whether you truly understand the business. Once you've identified a stock that piques your interest, you need to ask yourself, do you genuinely understand the company's business model and how it generates revenue? If the answer to that is yes, then that's great. That's a big win. That means that this company would fall within what Warren Buffett refers to as your circle of competence. For dividend investors, staying within this circle usually leads to better investment decisions and can help you determine which companies might be able to continue paying and growing their dividends over time. Now, once you found a business that you understand, the next step is to determine whether or not this business is growing, and you do this by looking at the company's financial statements. Learning how to read these statements is non-negotiable. This is something that you will absolutely have to learn how to do if you plan on investing in individual companies. And if you don't want to go through all of that, then it's probably best to just rock with ETFs, which is totally fine. I think that's an important thing to come to know about yourself as an investor. But if you do, then there are 3 main financial statements you'll need to learn. The first one is going to be the income statement. This shows a company's income and expenses over a specific period, revealing whether the company made a profit or took a loss for that period. Moving on, the second financial statement is the balance sheet. This offers a snapshot of the company's assets and liabilities, along with its shareholder equity, which is the difference between those two. And then last but definitely not least, we have the cash flow statement. This tracks how cash moves in and out of the business. And for dividend investors, this is a really important financial statement because dividends are paid from the company's free cash flow, so you definitely want to know what's going on there. Now, to figure out if a business is growing, you'll at least want to look at the company's revenue, you'll want to look at its earnings or its net income, and you'll want to look at the company's free cash flow, which you can easily do using Snapstock, which is a new stock analysis tool that I've actually been developing. This will be coming out with the Investor's Almanac, so definitely get on that wait list, guys. But anyway, ideally, you want to see all 3 of these things trending upwards over time, like we do here with Visa. And then, guys, once you found a growing business that you understand, the next step is to determine if the dividend is sustainable, and one of the quickest ways to do that is just by looking at something called the payout ratio. This ratio tells you the percentage of a company's earnings or its free cash flow that goes towards paying dividends. Now, looking again at Visa over here on Snapstock, their earnings payout ratio is only 21.5%, which means that not a lot of their earnings are going towards the dividends, so it's probably not much of a financial strain on the company, and the same is true with the free cash flow payout ratio here. This is actually lower. It's only 17.6%. So even less of their free cash flow is going to the dividend. That's a really good sign. But anyway, in a nutshell, those are a few quick things that you can look at to determine whether or not a dividend stock is worth exploring further. And as you go along, as you get deeper and deeper into this, I'm sure your checklist will expand over time, as it should. But I think this is a really great place to start. And with that, guys, now moving on to question number 4 from John Bishop. John asks, do you have any companies in your portfolio that you think are so solid that you'll keep buying them forever? Obviously, unless something big changed about it. And yeah, this is a really good question. I mean, ideally, I'd like to hold on to all the stocks in my portfolio indefinitely. And that's really the essence of dividend investing. It's a buy and hold strategy where you buy the stocks, you sit back, and then you collect that cash flow. And the simplicity of that right there is one of the things that I really love about this style of investing. With that said, though, forever is a very long time, and a lot can happen over a multi-decade investment period. Businesses can evolve, the world can change, and while there's no set expiration date on the stocks in my portfolio, I'm going to stay flexible and I'm going to stay ready to adapt to any developments as they come. But still, there are a few companies in my portfolio that I think are so fundamentally strong that, yeah, I'll definitely be holding on to them for a very, very, very long time. And that's what I'm telling you about in this next video right over here. In this one, I'm telling you about my perfect 10 stock dividend portfolio. If I had to narrow my portfolio down to just the perfect 10 stocks, these would be it. So click right over here to find out which ones they are, and I'll see you in the next one.